of profound change. Technologies like generative AI, blockchain, digital ID, and real-time payments, things that we barely heard about or discussed a decade ago, are now transforming financial systems. These innovations offer great promise by expanding access, increasing efficiency, and closing development gaps. But they also introduce serious risks, such as regulatory blind spots, cyber threats, and complexities. At the same time, development gains are under pressure. Climate shocks, rising debt inequality, and geopolitical instability are reversing progress. With the 2030 SDGs deadline only 5 years away, we must act urgently, strengthen coordination, and rethink our approaches. This is where today's conversation fits in. For the past 27 years, Toronto Centre has trained over 30,000 financial supervisors and regulators from 190 jurisdictions. Our mission is to build a more inclusive, stable, and resilient financial systems. This work is made possible by the support of Global Affairs Canada, Swedish SIDA, the IMF, Jersey Overseas Aid, and many other valued international partners. But capacity building alone isn't enough. Innovation and risks are global, and our solutions must be too. I'm delighted to bring you a panel of 4 exceptional panelists who bring deep expertise to shed some light on this conversation. They are Socorro Hyson, board member of Toronto Centre and former superintendent of banking, insurance, and pension fund administrator of Peru. Tamara Cook, CEO of Financial Sector Deepening Kenya. Hunter Sims is the associate director of business operations, Cambridge Centre for Alternative Finance. Olaf Weber, professor and a friend of Toronto Centre and CIBC chair in sustainable finance, Schulich School of Business. You've seen their bios, and I look forward to an insightful discussion. Before we begin, though, it is my honor to introduce Deputy Ian Gorst, whom I've met many times, the Minister for External Relations of the Government of Jersey in the British Channel Islands, who will bring us a special brief message. Deputy Gorst was first elected to Jersey State's Assembly in 2005. He has held several senior positions, including Chief Minister between 2011 and 2018, as well as Minister for Treasury and Resources between 2022 and 2024. Toronto Centre is very grateful for the support we receive from Minister Gorst and his ministerial colleagues at the Government of Jersey through Jersey Overseas Aid to fulfill our global mission of promoting financial stability, inclusion, and achievement of the SDGs. Our collaboration with the JOA began in 2019, and we are honored to be working across all their priority countries. Please join me in welcoming Deputy Gorst, and it's your floor now. Thank you.
Thank you very much indeed, and welcome everyone. As Babek has just reminded us, we meet today at a moment that demands both urgency and imagination. The global financial system is being transformed by technology, by climate change, and by shifting power dynamics. In many ways, of course, the regulatory framework meant to govern this system remains anchored in a different era. And if we are serious about accelerating development, we cannot simply tweak the old architecture. We need to redesign it with resilience and purpose at its core. Jersey is an internationally recognized finance centre which is highly regulated. And we are determined that finance centres like ours are part of the solution to the issues that the world faces. This means taking action. Last year, through Jersey Overseas Aid and in partnership with the Toronto Centre, our Financial Services Commission, that's our regulator, hosted regulators from Ethiopia, Malawi, Nepal, Rwanda, Sierra Leone, and Zambia for an intensive programme on financial crime supervision. Why, you might ask? Because illicit finance is not just a technical challenge, it is a development one. It erodes trust and it disproportionately hurts those already at the margins of our societies. So yes, innovation matters, but so does integrity. Through Jersey Overseas Aid, we focus on the people most often left behind, particularly women, young people, people with disabilities, displaced people, and rural communities. We see financial inclusion as a means to resilience, to dignity, and to opportunity. Today, over 1.4 billion people remain outside the formal financial system. The digital transformation gives us a chance to close that gap, or if we get it wrong, widen it. Regulators are being asked to do more with less and faster than ever. Emerging technologies are reshaping finance, but often outpacing supervisory capacity. So we must ask, who designs our financial future? Who benefits? And how do we ensure that this wave of digital innovation is secure, sustainable, and coordinated? Because without cyber resilience and without trust, we won't unlock the full promise of these technologies. We in Jersey are committed to playing our part. We can't do it on our own. And I once again want to thank the Toronto Centre for convening this important discussion and working in partnership with all of us. I'm sure that it will be both interesting, but most importantly, useful. Thank you very much indeed.
Well, thank you very much, Minister Gorst. We're honored to have you with us, and the support that you're providing is helping us to have events like this. So thank you. So let me just do a couple of housekeeping. Please note that we do have simultaneous French and Spanish translation. The icons are available below. Also, please do post your questions. We will have 2 rounds. So let's begin. The first round focuses on inclusion, stability, and capacity and coordination. So we talked about the expansion of digital finance, and regulators are really facing a dual challenge of enabling innovation that supports inclusion, sustainability, while protecting financial stability. And they really have to work hard to make sure that they do this in the context of limited capacity. So, and there's also cross-border issues. I mean, the challenges are numerous. So, Koro, let me start with you. How can supervisors promote inclusion and SDGs without compromising stability, especially in low-capacity environments? Thank you.
Thank you, Babak. Thank you for the invitation. I'm very glad to be with all of you. First, I would like to establish 3 basic premises. First, financial stability, of course, is the main objective of financial regulators because it is essential for a healthy economic environment, and a healthy economic environment is necessary for growth, for development, and for financial inclusion. Second, financial stability is necessary but not sufficient for growth, development, and financial inclusion. And third, SDGs are a reinforcement and not a trade-off of financial stability. And this is what gives supervisors an opportunity to promote SDGs and financial inclusion. So in general, it is desirable that policymakers pursue all financial stability, growth, financial inclusion, and sustainable development goals. Multi-sectoral strategies are important to this end. Effective financial inclusion requires the leadership and the coordination of the authorities responsible for these functions. Besides financial regulators, these authorities may include, for instance, the regulator of the payment system, which is usually a central bank, to foster inclusion of all citizens in a national, competitive, and fast digital payment system. The authorities overseeing the telecommunications sector, to ensure that the people have access to internet, for instance. The authorities involved in education, in development, in women's or gender issues. So all of these authorities are part, or even the authorities responsible for privacy, data privacy, and cybersecurity. So all of these authorities have to be involved in a national strategy for financial inclusion and for pursuing these goals. And depending on the institutional arrangement of each country, financial regulators can act decisively to support or even to lead in some of these goals. Of course, supervisors that have a comprehensive mandate, which includes market conduct and financial integrity, have a clearer path than supervisors that have a narrow mandate. But even supervisors with a narrow mandate on only financial stability can rationally promote financial inclusion and SDGs. For instance, financial regulators could promote a financial environment where financial institutions have adequate incentives to provide customers with a broad range of products and services available through various channels so that they can be accessible to diverse populations within a country. An environment in which these products are designed considering the needs of their customers so that customers not only sign up for financial products, savings, loans, insurance, or pensions, but actively use them and value them. In this environment, customers will have a closer relationship with the financial system, and therefore they will be more confident on the financial system, and the financial system will be thus more stable. So this is something that is very important. So now I can answer your question. So how do we do this? No, first, I think strong market conduct, regulation, and supervision are key to this, including promoting responsible business conduct, fair treatment, sufficient information and transparency, and other customer complaint system addressing and redressing their customer complaints, quality financial products, digital safety, protection of fraud and scams, and financial literacy. All of these are roles that the regulator can pursue to create a healthy environment for financial inclusion. So all of these assist the populations in achieving their goals, in being more productive, in managing the risks. And all of these are also included in the high-level principles of financial consumer protection of the G20 and the OECD, which can be used as a benchmark to strengthen their countries' frameworks. We can pose the example of SBS, for instance, in Peru, which is not only an active participant in the National Committee of Financial Inclusion, but leads the country work on several of these goals. So in low capacity regulatory institutions, resources are generally overstretched, and supervisors will need to prioritize their objectives and goals and manage these resources. So progress probably in phases is the best. With small, motivated, result-oriented teams, you can achieve a lot, especially if you leverage technical assistance that is available internationally. And you can also use artificial intelligence to expand your capabilities. And of course, developing human capital to do your work more effectively. All of this will assist the country to promote financial inclusion and SDGs. Thank you.
Well, thank you very much, Socorro. That's a good start. And your headline is progress is best done in phases. I really like that. So let's carry on with that. Tomorrow, I'm going to come to you now and ask you what regulatory shifts best support inclusive finance and how can supervisors integrate sustainability without getting overwhelmed? Thank you.
Thank you, Babak. And Sakura, I think I really want to build on and amplify what you've said, not knowing what you were going to say in advance. I love how you talked about it's not a trade-off, right? It's not mutually exclusive. It's actually mutually reinforcing when you're thinking about stability and inclusion, when you're thinking about stability and sustainability. I think if we see that as a false dichotomy, then the regulatory shifts that you've just asked me about could be complicated, right? When we think about Kenya, which is what I'm hoping to speak a little bit more about today, we can see some clear regulatory shifts that helped increase inclusion and had, increased stability at the same time. The most famous one, although it's a long time ago, was around mobile money and the regulatory shifts that happened there to enable mobile money and to enable diversified agents where people could get cash in and cash out outside of the traditional financial sector. But then if you think about how then you shift from that and you move up, you can also go from just enabling people a place to store money and send money to moving beyond that and leveraging that to offer additional financial services. I think another false dichotomy we can have is inclusion versus inclusion that actually helps people achieve their financial health. It just including somebody in the system doesn't necessarily make them stable unless they can use a financial system to manage day to day, to deal with risks and invest in the future.
Absolutely.
And so if we think about just including someone, it's not enough. And it won't achieve that goal of sustainability. It won't achieve the goal of stability. So then, what we've seen in Kenya is that using digital technology like mobile money has enabled other use cases like digital credit, digital savings, access to different kinds of insurance and pension services. One of the things that we did is working with different financial sector regulators, and I really liked how you talked about the role of the different regulators with narrow mandates and broad mandates. And I think it's also important when you have a joint financial sector regulator group. One of the things with digital innovation is that it's often not just in one regulator. And if you only deal with one regulator, you're missing out because the innovator needs a payments improvement here and a capital markets improvement here, et cetera. And so really figuring out how a joint financial sector regulator group can enable this kind of the kind of regulatory shifts that are required. We worked closely with the Capital Markets Authority, who was the first to launch kind of a sandbox here in Kenya to enable capital market innovators to use different kinds of technologies. And we've seen many fintechs kind of enter into that sandbox and move out of it, but they often also had to work with the other financial sector regulators. In the Central Bank of Kenya, when they talk about inclusion and stability and sustainability, they talk about them together. Again, they don't talk about them as competing priorities. When I think about the kind of even more recently, before the event we were talking about the importance of climate. In Kenya, climate change is happening to us. And so because it's happening to us, we have to, as a financial sector, look at what those risks are and how those risks are affecting the way that we address things like inclusion and sustainability. At the same time, there's opportunities that are unlocked when we look at climate in new ways and we think about adaptation and access to different pools of capital that might be able to be attracted to Kenya to help deal with some of the sustainability challenges that we face. I think new areas or new ways of thinking about finance, like open finance, is another opportunity that Kenya is exploring, but still really in the early days of figuring out, is this something that's interesting for others, and how will it actually unlock value for Kenyan innovators, for Kenyan families, for Kenyan enterprises? Maybe one example I'll just close with on this first question is around the Guarantee Fund that was launched during COVID here in Kenya. There had been an idea before COVID happened for the government to launch a guarantee fund for micro, small, and medium enterprises to really try to unlock more capital, more credit for that sector. When COVID happened, that plan got accelerated and happened very quickly to try to get something in place to really help businesses that were struggling with that shock, right? That was a shock to stability. It was a shock to sustainability. And frankly, it was a shock to inclusion too, as people lost some of their livelihoods and incomes. One of the things that happened in that guarantee fund was a small change, or that didn't always happen, which is that gender was a required field when that fund was launched. There was not a requirement on how many women needed to be reached. It just said, if you're going to reach micro and small, medium enterprises, we want you to say, is it owned by a male? Is it owned by a female? And just including that metric helped highlight how many more men ended up being in the first round of getting that fund versus women. And you could see that just including that field is a way to increase inclusion, increase sustainability to reach the broader part of the population. Because the first time the report came back and the banks could see, oh, wait, that's how many women we reached? We can do better than that. We can do better than that. And so I do think that regulators and supervisors have the opportunity to just expose data, to report data on sex disaggregated data in ways that help people make better decisions to increase inclusion, increase sustainability. And frankly, that has an overall impact on the broader goals of stability. Thank you. I'll stop there.
Well, that's great. Actually, these are very, very interesting example, and I really loved that you talked about how inclusion and stability go hand in hand. That's actually true. That's what we've been saying for years. So every time I hear someone say that, I want to just go and just give them a big hug. Also, the thing about sex disaggregated data, for those of you who might not know, Toronto Centre did develop a sex disaggregated data toolkit several years ago by a well-known organization that no longer exists. I think they're called USAID. So it's open source. Please take a look at it on our website. And now let's proceed to the next questions. Hunter, I just had lunch with you, I think it was 3 or 4 weeks ago. So it's good to see you again. What should regulators understand about innovation in frontier markets, and where do blind spots for regulators remain? Thank you.
Thank you, Babak. And yes, absolutely a pleasure to be here. I really enjoy this question. We do a lot of thinking and work around this question, and it's an incredibly broad one. So I'll happily address a few of these kind of core areas in response, and then happy to go into more detail in the Q&A as desired. So first, before going into any real detail, I think it's important to acknowledge the standard deviation between how financial authorities engage with innovation is really large. So there's some financial authorities who are really kind of on the cutting edge in terms of leveraging technology and also regulating technology. And there's others kind of considered the long tail of financial authorities who are somewhere in the journey and have maybe some specializations or are really kind of getting their heads around how to innovate and also regulate innovation itself. So, I'll focus in kind of broad terms, but each jurisdiction has its own specific kind of countenance towards innovation. First, and I think fundamentally, it's important to acknowledge that innovation doesn't wait for regulation, and neither do consumers. So when we're talking about things like consumer protection and sustainability, financial authorities don't have the luxury of taking a wait and see approach when innovation is happening within the market. There are countless examples of this that have caused consumer harm and that have also reduced consumer harm. Perhaps something in the last year that's worth noting, that's not just looking at addressing financial systems from a cheaper, faster, more accessible standpoint, but actually fundamentally reshaping how financial systems work. An example of this would be stablecoins and the significant growth of stablecoins over the course of the last year and a half, roughly. So currently stablecoins are trading or in the market over $250 billion, which is over double at the end of 2023 or October, I think 2023. This is market response to a market demand. And financial authorities do have a responsibility to try and keep pace with this innovation when it is happening and where it's happening. So there's lots of talk about in projects exploring retail and wholesale CBDCs, faster payment systems overall innovation. And that's happening in a real context where things are live and shifting in the market today. And I think that's important to keep in mind for financial authorities as they focus on where the core priorities are. Unhelpfully, innovation has never been as fast as it is today. And even more unhelpfully, it will never be this slow again. So this is not a race of a steady pace. This is exponential growth that will continue to grow exponentially. I think the second kind of broader point is how important it is to focus on the specific context in which a jurisdiction operates. So not all innovation is created equal, and also not all innovation is directly applicable kind of across cultural, country, or regulatory jurisdictional boundaries. For instance, a jurisdiction that has heavy flows of remittances, cross-border remittances, will have a very different should have a very different focus on innovation that's happening within that field, as opposed to a jurisdiction that has a more heavily domiciled economy. I think in terms of blind spots, there's a few things I'd want to highlight here, but maybe two big ones that I think are fundamental. There's lots of conversations and talk, and has been for many, many years, around the importance of data. And data asymmetry does need to be addressed. So the market, fintechs, banks, and the like have increasingly high fidelity data, which is fantastic, and it's leading to greater insight, which is also fantastic. Financial authorities also need to explore how to harness data most effectively. Everyone's aware of that. What I think there's probably not enough emphasis on, though, is not just the harnessing and generating of data from a reporting standpoint, but it's actually how to leverage that effectively. And while everyone likes to talk about this year, particularly AI and the functions and benefits of it, first principles in terms of data architecture and interoperability, building on top of that, then semantic layers and applications that allow for the leveraging of that data rather than just the capturing of that data, I think is something that requires a lot more focus within financial authorities more broadly. And I think the other blind spot that I'd highlight is a real need to dissolve the myth of the us versus them divide when it comes to financial authorities and market participants. This is true, I think, globally, but it's particularly true, I would say, in frontier markets and emerging and developing countries. Every actor has a role to play in establishing sustainable, inclusive, and growth-oriented financial market. Of course, the financial authorities have a role to play. Private actors do as well. But in the face of this increasingly exponential innovation, public-private partnership is essential. So leveraging any opportunity or mechanism to establish that, I think is time well spent. So sandboxes, interoperable data architectures, shared models, open source work. There's lots of work that can be done in leveraging technology to address how technology is informing and being regulated within financial systems. I think that's the other point I'd make. And lastly, I would just heavily echo the points that have been made by Tamara and Socorro as well on the need for joint regulatory coordination, so cross-cutting regulatory coordination, as well as, importantly, and Babak, as you did as well, emphasizing the need for focusing on sex disaggregated data, something that I think can sound maybe more obscure than it is in terms of real practical implications on how the market responds and reacts. Yeah, I'll leave it at that for now.
Well, thank you very much. And it's very encouraging to see how all of you are reinforcing each other's comments. Maybe I spoke too soon because we have to go to Olaf. Olaf, how can technology help regulators measure development impact beyond ESG box ticking? I love that because greenwashing, box ticking. Go for it.
Thank you. That's a great question. And I think first we have to realize that, and I've been involved in the development of some of the big ESG rating systems. These systems are made for corporations. So they are made that corporations can use them and can show how great they are, mainly, how well they do financially if they do ESG. But of course, they can use them in their advantage as well. And so you have to be careful in what they say. And so that's maybe the first point to realize. Then I think the question is, what is ESG box ticking? We are quite aware of what it is, but maybe I say some words about that. It means we use the ESG indicators to demonstrate that a company addresses one or more ESGs. So in case of the development case. So these indicators are, for instance, access to electricity, access to water, number of decent job created, or local government support. So these are all ESG rating mechanisms, and so companies can talk about it. And so more or less what happens then, points, so rating systems assign points. Do you do something to enable access to electricity or not? And then you get points to that from 1 to 10 or something like that, depending on the rating. And then you sum them up and you have a full rating at the end. So this is the kind of the box ticking that we see. Of course, it's a good start. You have some useful information. Whether a company is doing well in some fields and not doing well in others. So, but think about what happens if a company provides access to electricity to 90% of the companies, the people in their community. That might be great. It's a utility or a power plant, a hydropower plant, that uses all the water to produce the electricity. So on the one hand, of course, they provide electricity. On the other hand, nobody has the water anymore. But at the end, as a consequence, your full impact might not that positive. Discussing weather and climate. What about contributing to economic development? That is an SDG as well, but slashing our climate. So same. You can be great in one SDG and not as great in the other. And so what we need here is technology of course, can help to connect the dots. And I will talk about some of these technologies later. So there could be statistical measures, that are used to, regression and all these things to figure out how a company is doing. AI-based pattern recognition, talking about AI, we can see, are they these kind of contradictory issues between different ESG indicators, for instance. And so we can get a broader picture using combinations of many data points. So that's something that is useful in contrast to just purely ESG box ticking. So, but agreeing to Hunter, we have a lot of data. So having data is not the problem at the end. The question is to pick the right data. What is really useful to figure out, is it valid and reliable? So does it measures? Does regarding climate really measures emissions, or what does it do? Is it reliable? It does time a lot. How can we use to measure the development impact? And so this is not trivial. Just have a look at scope 3 emissions. And you see they are not valid, they are not reliable at all. And so that's just an example. And social ESG indicators are even more tricky, because it's not easy. So second, if we want to measure true development impact, we must shift from so-called compliance-based ESG. See, okay, what do they do? How do they address our regulations? We need to go to a result-based ESG. So we need to know what is the impact at the end, and measure this impact and by creating transparent and verifiable outcomes. Third, good ESG or SDG mean high and positive impact. We need to distinguish between reporting and actions. So we can see that many companies, especially in industries with negative impacts, are actually pretty good reporters. They know, how to report things, and so we have to be careful. With that. But what could be some ways how technology helps? If you want to measure impact, think about digital monitoring, remote sensing. So actually verify if a company says, they decreased their deforestation in their business, we can use these type of data to measure it. Drones can also be used for these kind of positive things, so we can measure and verify what they tell us in the reports. Another example is blockchain. One issue in the supply chain, for instance, with ores and metals, where does it come from? It's often coming from developing countries. Is there modern slavery involved? Things like that. Blockchain can help to address this thing, for instance. And what I want to talk about is natural language processing. Everybody who ever has analyzed a written report knows how much work that is, because it's, you have to read through it, you have to analyze these things. I did some projects analyzing sustainability reports, and you can use AI and natural language processing to analyze these reports, also to see whether they are aligned to SDGs or to other indicators and so forth. So this is really helpful, and there can be tools that can be developed for specific users. So for instance, you can train these tools, especially to look at SDG impacts and things like that. So I think this is really great. So to finish, maybe all these tools, I think, can help supervisors and regulators to conduct a more result-based analysis. What we want to see at the end, instead of just box ticking compliance based supervision and regulation.
Well, thank you very much, Olaf. I think you helped round out the conversation. I think we had a very strong first round. We're going to go to the second round. Gratitude to the speakers, but I just do have a challenge for you speakers. We have questions trickling in. A lot of people are there. We want to be able to get to them. And if I could please ask you to limit your responses to the allotted time, 4 minutes would be great. I know it's not fair, but let's do the best we can. So the second round, we are going to look at innovation with guardrails and how we move from pilots to policy to deliver real inclusive impact. Socorro, in 4 minutes, it's better than CNN. CNN gives you 30 seconds. In 4 minutes or less, how can regulators stay ahead of fast evolving technologies like AI and blockchain while managing risks? Thank you.
Thank you, Babak. Well, first, technological advancements are nothing new to the financial system. However, artificial intelligence does accentuate known risks, generates new risks, and creates opportunities. So, of course, the use of technology increases the risk of system and operational failures, exposure to cyber attacks, outsourcing risks, and even contagion risks because of the use of the same service providers. These are known risks. There are partly known risks that have to do with, for instance, the black boxes that are the nature of learning AI systems used by financial institutions. In this context of black boxes, we may have models that not even the financial institutions understand, because they are continuously learning, and they even risk giving up human control in some of the decisions that they are taking. And the unknown risks are more related to the use, the role of the big tech firms are going to play in the landscape, which are firms that are not under the regulatory purview, and that these may have strong supervisory implications. Of course, it also presents opportunities, increasing the effectiveness and the efficiency of operations. The risk analysis is better in credit decisions, insurance, underwriting, asset allocation, etc. So how can regulators deal with all this? First, I think it is important to understand that the broad mandate of supervisors is going to stay the same. Even with all these fast changes, the role of supervisor is still maintaining public confidence and trust in the financial system with efficient financial markets and fair and transparent markets. So the core characteristics requiring the supervisors remain unchanged from the supervisor today. They still have to have high integrity, commitment to public service. They have to be curious about latest developments and alert to risks in the financial sector, and willing and able to learn quickly on the job. So the supervisor will need to be even more agile, more innovative to respond to the changes in artificial intelligence. Evaluating risks, assessing risk management and governance, preparing for crisis in an environment in which crisis can unravel at a faster pace, requires a lot of agility and a lot of fast decisions that have to be taken by supervisors. So all of these require critical thinking and judgment, because no two financial institutions have exactly the same business model and risks, or the same government or risk management or internal control structures and financial resources. So it is not possible to feed a financial institution's data into an AI system and automatically generate supervisory plans and remediation actions. Still, supervisors need to have a lot of judgment, and that is the key for a financial supervisor. So developing human capital is still the basis for financial supervisors to stay on top of these things. Develop regulation and revise it regularly to understand the risks and governance of financial institutions, and all of this will generate bottlenecks and scarcity of qualified staff. So how do you solve the problem? Well, again, it's the same thing. We need leadership, strategic thinking, motivated, goal-oriented teams working on specific programs. We need to do all these things and also leverage artificial intelligence and technical assistance to do our work. So I'll stop here just to
That's
continue
great.
with the 4 minutes.
Well, actually, you hit 4 minutes, which is phenomenal. But also, you said something very important, which is the business of supervision doesn't change. Trust and confidence is actually paramount. And for the audience to know, the BIS Innovation Hub London has asked us to write a chapter on supervisor of the future. And our argument was critical thinking and judgment are the qualities supervisors must defend in a rapid rise of AI. So thank you for making that plug for us. Tamara, over to you in 4 minutes or less. Can you please give us an example of a scalable case where regulation-enabled tech to serve vulnerable groups happened, and what's needed to take that case global? Thank you.
Great. I've already mentioned mobile money and the story in Kenya. And when you look at the pace of innovation and change, it took 115 years for banks in Kenya to reach 25% of the population. It took 2 years for mobile money to reach 25% of the population. And when you look at that pace of change, we've already heard about how the pace of change is only going to increase. I think it's a telling example of how technology can unlock that inclusion and including more people into financial opportunities. When we think about banking in particular, the example that I would like to discuss is how you leverage a platform like mobile money to unlock more banking services for the population. The first bank in Kenya that sought to leverage that mobile money platform to unlock bank accounts for Kenyans used the same kind of KYC requirement that was used for a traditional bank account. So they had to go and take a picture of the ID, they had to have a paper form. And I remember walking into a boardroom that had stacks and stacks and stacks of paper so that those accounts could be opened. The next bank, a few years later, who wanted to do a similar thing and launch that mobile money enabled bank account, was able to get a regulatory approval to use the SIM registration in the SIM card to do the know your customer requirement. And so it was really collecting the same kind of information, but doing it in a different and new way that was more cost effective, enabled more people to do it, and enabled remote opening of accounts instead of in-person opening of accounts. And so that's an example of something that can scale more quickly and how we can learn from. It's still really important to know your customer, but what are the unlocks that technology can provide to enable us to know the customer and protect the customer in ways that still unlock that the access to new accounts? And mobile money enabled bank accounts now are more than 30% of the population. Again, remember that thing I said at the beginning, banks took 115 years to reach there. Mobile money enabled bank accounts only took a few years. And so I liked the question that we heard at the very beginning about who designs our financial future. And we could say, oh, we're on a regulatory panel. It must be the regulators who design it. No. Or maybe it's the providers, right? The innovators. They've got new technology and they can leverage AI and stable coins and whatever, and they're going to design the financial future. I don't think so either. I think it's actually the users of finance that are going to design our financial future because of the way they use it and what providers and supervisors can learn to have almost like a co-creation process with the consumers of finance who are going to be the ones that design the way finance is used to achieve their goals in the future. In Kenya, we've seen a lot of misuse of finance and guardrails not being in place. And so as we design our financial future, I think it's important to think about what the opportunities, what we haven't even imagined that people will use this new tool to do, but how do we protect them as they do that? Digital credit is short-term in Kenya and expensive. That's good for managing day to day. It's not good for investing in the future. So how do we learn from something that's really helpful and has opened credit to a lot more people and use it to leverage that next stage, that next future, financial future for Kenya? I'll stop there. Thank you, Babak.
Well, that's great. And actually, so change is very cumulative, Tamara, as you mentioned. And the example you have about the pace and change of mobile money is quite something. So thank you for that. Let's move to Hunter. How can fintechs partner with regulators to design risk-aware tools, especially around cyber risk and consumer protection? Thanks.
Thanks, Babak. I'll be quick. I promise. So, as I said before, the opportunity for partnership isn't really optional anymore. It's structural. It's necessary, and I think that that will prove itself out in the coming years, even more so than it has in the past few years. First, I think it's important to highlight the work of what's happening in the industry now, where technology is being leveraged through compliance functions, reg techs, fraud monitoring, to reduce consumer harm, and increase or reduce also cyber risk, increase cybersecurity. So for instance, recently Stripe reported its AI-powered transformer model around its payments model. That their reporting has had a significant increase in terms of their ability to detect fraud in large users, something like high 50% recognition to 97% recognition. I mean, that's definitely qualifies as transformative in terms of reducing consumer risks. I think in order for the industry to most effectively work with financial authorities in that way, as much of that as possible should be done out in the open, right? Through open source representation, public documentation, the opportunity for regulators to scrutinize, to have kind of the door in and out, kind of in the open, right? So I think that's already happening. It's happening more and more as this sort of trust divide between the market and regulators is being appropriately minimized. But I think we need to see more of that. And then the second, I think, is really all parties, including particularly kind of more broadly, the ecosystem in general, focusing on creating environments for collaboration to naturally flow. This is one of the things that kind of a title emphasis that we have in one of the initiatives that we're running, the Cambridge SupTech Lab, which we're running in collaboration with Digital Transformation Solutions. So Simone DeCastri and Matt Grasser, who have been in the supervisory technology space for a long, long time. We have a couple of kind of key areas of focus. One is actually literally making space, physical space or virtual space for cross-financial authority and cross-market dialogue. Our kind of title example of that is the SupTech Week that we run on an annual basis. That's continuing again this December, really for the opportunity to do exactly this, to explore this question. And then second is more structural, right? How do you actually create opportunity for firms to marry up with financial authorities by de-risking procurement? We do this through application incubation, right? So actually meeting supervisory use case needs with vendors in the market who actually have solutions or are developing solutions to address those needs. There's some serious principles around how to do that well. One is naming and articulating clear alignments of interest, defining the roles and responsibilities, documenting that. And I know it's not the most exciting thing to talk about, documentation and policy and process, but actually this is what unlocks that collaboration. And second, the ability to be creative and agile, right? So rather than taking a sort of monolithic approach to solutions, taking an agile human-centered design approach, testing, iterating, that is not a process to go through. It's a mindset for continuation, I think, in the creation of solutions by leveraging technology to address cyber risk and consumer protection. So I'll leave it at that for now, but a couple of thoughts that happy to explore further.
No, that's great, Hunter. And I think, even anybody who uses chat or other things, I mean, the more you engage it, the more you get out of it, rather than just asking it to do something. And I think your point about iteration and work is absolutely critical. Olaf, you're going to help us finish the second round, then we're going to go to the audience. So in 4 minutes or less, if I could ask you, are current regulatory frameworks ready for AI in finance, and what new tools or partnerships are needed? Thank you.
Thanks, Babak. And probably you would be disappointed if I say yes to the first question. So I don't think that they are probably not ready for this challenge. Another field, for instance, a lot of central banks still see climate change as a future risk for the financial sector. So just keep that in mind. Not a current risk, a future risk. So they are not at all in that. So let me start. An interesting thing. So I did my PhD in the mid-1990s, working on AI in credit risk assessment. So of course, this was totally different type of AI. But the main issue, and this was what Socorro said before, the main problem is the black box approach. So let me explain that. So you use AI to assess the default risk of a borrower, for instance. It can do great. You might get a valid, reliable result, and then you meet your client, and then you have to explain that your client why you charge them 2% higher interest rate. And what can you say? You can say the AI, figured out that you have a higher risk, but you don't know why, because usually the credit officer, the manager, does know that, how exactly this thing work. Experts can figure that out, but this is the first step. But then as the next step, you have the supervisor supervising this credit portfolio or having a look at that credit portfolio. And again, you don't really know how risks are analyzed because it's done by an AI. So how do you analyze as a supervisor, how you assess the risk, how you assess the assessment or the risk assessment process of the bank you're supervising if this bank uses AI. So this is really complex. And so I think this is one of the main problems we have to deal with. And of course, we need the capacity building, as Socorro said. But I think we need much more. One issue, for instance, a supervisor or regulator sets regulations at the point in time, and then others have to follow. In contrast, AI develops continuously. So we all know if we have used AI a year ago looked totally different from now. And nobody will, if you are a lender or a bank, you won't use the AI from last year just because it was, because the supervisor kind of gave it a go, so approved it. So you want to use the new stuff. So how do we deal with this kind of dynamic development? So because it does not make any sense to use older versions because it has regulatory approval. So we need these kind of new tools and regulatory framework to address such issues. I think, of course, if the financial institutions use AI, probably the regulator and the supervisor needs to do it as well. So we need to analyze these things. In addition to that, we need some probably new accountability rules for these algorithms. So how transparent do they need to be that we approve them? How do they work? What is the hit rate? So the positive and negative, how many mistakes does it do? So probably have to think about what kind of criteria do we have there? And then I think finally, all this has to be internationally because AI is international as well. So we cannot have domestic approaches to an international problem, probably. So we have to figure out how we can do that. And Babak, you mentioned BIS trying to do that as an international body. So I think what we need is new tools, new policies, and new partnerships, as have been mentioned before, to govern AI responsibility in finance. And probably regulators need to invest a lot in AI literacy, in the tools that they can use to supervise the AI, and probably a lot of collaboration that is needed to stay ahead of these systemic risk and also to protect consumers at the end.
Great, that's excellent. So that's really good. I think you made a good point on this one, which is actually brings us to the audience Q&A. And with permission from our speakers, if your time allows, I'd like to extend this by about 7 minutes just so we can catch up a lot of the questions. I hope you can stay. If you must drop out, I understand. But there are some really good questions, and I'm going to try to group them. So maybe there's some synergies there. For this round, Socorro, we're going to the CNN 30 seconds, right? Because we want to get a lot of questions, everyone. So let's see what we can do. So this question is asked by our friend Arvin, but also others. The Courageous Anonymous asked one too. So I'm going to try to group them. Basically, it's about the impact of political change, regulatory change, and all of that stuff that's happening now. So it's been suggested that innovation is being reframed in the current political climate, geopolitical instabilities, certain elections in certain countries. The question is, how can regulators continue to foster inclusive, sustainable finance under new political constraints? Socorro, you're a retired official, so you can speak more. I'm wondering if I can ask you to take a crack at this question, if you feel comfortable. Thank you.
Well, that's a difficult question to answer.
Yeah.
Really, I think regulators can still do the same thing. Continue doing financial inclusion and to continue doing, I mean, the market conduct, the financial literacy, and all these goals that the supervisors have that go beyond financial stability are not going away. And I don't think that any government can argue that that is not something that a regulator should pursue. I mean, at least I haven't seen that yet, at least not in Peru.
Yeah.
Perhaps in some countries in the first world, you were looking at politicians that are arguing against consumer protection, but that is it's difficult to argue.
Yeah.
Really, it's
Yeah.
very difficult to argue.
Yeah.
So I think you just have to continue
Yeah.
to be technical and pursue your
True.
job, and that's it. I mean,
I can just share a couple of examples here. Like I was talking to a superintendent of a financial institution in an advanced country, and I said, "How are you dealing with climate issues?" And this individual, she said, "You know what? We're still doing the work. We're just labeling it differently." Or right now in this global conference at the UN in Seville, the world is here, and the topic of climate is huge. I've talked to a lot of Europeans, but sometimes when you go to the United States, talk to some US officials, it's as if like the climate is not really an agenda. So I agree with you. It kind of goes back and forth. So, and as you said, there's no easy answer, but it's a good question to ask because for several years we've been focused on SDGs, and now some are saying maybe not. But what do we do now that all these tools have been developed? Hunter, we talked about, and tomorrow too, about sexist aggregated data, and all of that is out there. Like you cannot put the genie back in the bottle, and you should not. So tomorrow, actually, somebody said they have a question for you, so I'm going to give this to you. From your experience from Kenya, how can the innovative financial services be expanded to other countries not yet digitalized, like they bring up an example of Burundi. I don't know if you want to specifically talk about an example. I'm asking this question because I am from Burundi and would like to see how to collaborate. So it's a bit specific, but go ahead, please.
Look, we've had lots of people come to Kenya to say, wow, M-Pesa, we want to have that. You can't do it. You can't do it like Kenya did because it was at a different time. It was at a different situation, and you can't copy paste. Copy paste doesn't work in innovation. And today, even though Burundi may not be as digitized as Kenya was, say, in 2007 when mobile money was launched, you have a different opportunity set than you did then. And we in Kenya leapfrogged. Burundi has an opportunity to leapfrog in different ways. And so we'd love to have that conversation with you. Feel free to reach out to me, and we can talk about what's happening in the East African community and how we can do some of that. I think scenarios is another thing I'd just like to say. You know, whenever a regulator makes a decision to enable something that they don't understand yet, think about imagine what might happen. And you won't get it all right, but at least ask the questions. What could happen? What could go wrong? How could people be hurt? How could the market structure end up in a way that we may not have thought about in advance? And so those would be the two things I would say. Thanks, Babak.
No, thank you. That's great. So Hunter, I'm going to ask you to put a bit of a supervisory hat on, but this question has technology angles, so I think probably best to come to you. Given the rapid evolution of digital financial services and the increasing complexity of financial ecosystems, how can supervisory authorities enhance their offsite surveillance frameworks to effectively monitor systemic risks, ensure compliance, and promote financial stability, especially in jurisdictions with limited access to real data and advanced analytics? This is probably something you've thought about. Go ahead, please.
Yeah, absolutely. No, it's a great question. And actually, I think offsite supervision, perhaps frustratingly, isn't addressed often enough as part of kind of a holistic approach to how financial authorities do innovate. The worst possible outcome really is that the financial authority has supercharged tech capabilities and supercharged talent to leverage existing data sets and future data sets, but actually there's no connectivity at all in language, data, information, questions between that and what the offsite supervisors are actually doing. So actually over the course of the last year, we were working in Indonesia with OJK, and we did a really significant, actually over 1,000 offsite supervisors training, basically doing two things. One, establishing common language between what offsite supervisors engage with and what the sort of internal headquarters staff through the project management office and the like, and OJKE, the capacity building education part of OJK, do to kind of create joint foundational language. It's amazing what something as simple as that can do in terms of enabling collaboration to continue on within kind of naturally within a financial authority. Because if you don't have that common language, there's no real starting point. And then the second component was really to identify opportunities where offsite supervision could modify what it's doing in response to taking some of the supervisory burden off of the hands of the offsite supervisor, so that what they where and how they do intervene is more precise, more surgical, more context specific. So basically leveraging the existing, it's not a story of technology displacing human effort. It's a story of technology creating opportunity for human effort to be extended much more broadly and much more significantly. And I think that connection point is very, very important when thinking about an overall financial authority approach to transformation.
Excellent. That's very helpful. Olaf, I'm going to come to you. This is a forward-thinking question from our friend Rudy, and he's talking about the leapfrogging advantage of technologies, right? We can just leapfrog over certain things. He's interested in views on how emerging technologies such as AI, RegTech, and data analytics might enable us to tailor regulatory frameworks specific to market segments, thereby incrementally shaping a financial system that is more customer-centric, transparent, and accountable. I mean, what is your view on that?
Yeah, I think this might be an opportunity. We have seen that, what Tamara mentioned with the use of mobile phones, and after I was in Tanzania as well, in Kenya, it's great, and they just leapfrogged a lot of things. And so I think this is definitely an opportunity that can be used by supervisors and regulators in emerging countries. I think it can be helpful. You need to train less people. On the other hand, you need to train them in a better way. They need really to be experts to deal with these technologies. But I think it's a massive opportunity that can. I think the difference in work hours is as well that you can decrease, or that you need to do your analysis, your supervision is significant, and also the new technologies that you can use, and as well, and especially if you have other fields where you see this leapfrogging, you can follow, and you need to do that. And so, short response, I think yes, it can be used, but of course we need to have good guidelines and good processes that countries are able to use it.
Excellent. That's good. So, Cora, the next question goes to you. I think talks about some broader international collaboration. So, Risha asks, mentions you by name. So, Cora mentioned about contagion risk. There is increasing cross-border risk as provider of AI, perpetrators of crime could be outside of your own jurisdiction. What guidance would you give for supervisory agencies to deal with cross-border risks under the current circumstances? Thanks.
I think that in this context, international collaboration is key among financial regulators across the world, among financial institutions across the world too. It is important because when you have a cyber attack in one country, and there is criminals innovate and innovate very fast. So you have a cyber attack in one country, then you will have the same cyber attack in a different country. So if financial institutions are able to collaborate across countries, and financial regulators are able to collaborate across countries, that will help them deal with this continuous innovation of crime, which is something that is really a real risk and something that we are facing. And let me take it at that.
That's great. And Tamara, there's a question specific here. Again, I see the word M-Pesa, so I'm looking at you. Should regulators allow early stage innovation to develop under flexible rules before imposing stricter regulation, as was the case for Kenya's M-Pesa? What should be the key considerations? How can regulatory sandboxes be used? So please take any aspect of this that you can in a short amount of time, because I think there's a lot of interest again as the Kenya model, and but now it's a new world. M-Pesa was many years ago, right? So go ahead. Yeah.
It's impossible for regulation to keep up with the pace of technology change. It's just not possible. Regulation must move in a certain way, and it has increased its pace as well of change, but it's not possible. And so I think the short answer is yes, and the longer answer is yes, but. In Kenya, I think, it was 2007, or actually it was around 2005, that the no objection was given for mobile money to develop. And the regulation and the act that regulated that came almost 10 years later. And so that's too long, right? And so I think, yes, let innovation develop and catch up as quickly as possible. And again, that scenario analysis that I talked about from before is really important, to look at what are the possible unintended consequences, what might happen that we haven't thought about. And as change happens, don't wait till the next time the act is renewed to make changes through policy guidance notes or other ways, the tools that regulators and supervisors have to change things as the market changes and develops. I think, but we must not let regulation be a barrier to innovation, and we must make sure that those boundaries are in place to protect consumers and the market development. Thanks.
That's actually a very good way to end, Tamara. I think you really, I think, encapsulated what we were talking about, what we were working towards, and it's very synergistic with everything else discussed here. I apologize for everyone for going over time, but the conversation was very important. But just to let you know, it's very interesting. This panel, nobody talked about themselves. Nobody had a long speech with a PowerPoint. The conversation was extremely substantive. This is something we can use for our training programs. So the speakers have our gratitude. The questions that were left on the table, we will have them and we will try to deal with them one way or another as part of our regular capacity building programs. Thanks again for tuning in, and hope you have a great day, and hopefully you're in a jurisdiction that's much cooler than I am. Tamara, I don't know where you are, is as warm or as hot as where I am, but 42 degrees is a bit too much for me. I really love to be able to work out in a park in Toronto in minus 21 degrees in the middle of winter than be here. Okay, thanks again, everyone. Take care. Bye.
Thank
Thanks
you.
all. Bye.
Thank you.